Rising interest rates are impacting nearly every aspect of the U.S. economy. An article in Axios takes a closer look at how the mortgage refinancing boom of 2021 seemed to run out of steam and why, of course, those rising rates are to blame. Axios' markets correspondent Matt Phillips wrote the piece, and he is here to talk a little bit more about it. So first off, let's just start off with kind of like explaining how mortgage refinancing works and what fueled the spike last year.
Well, essentially, low interest rates fueled it last year. When people refinance their mortgage, they have an incentive to cut their monthly payment, essentially, when rates are low. And so what it does is it takes a lot of money out of your monthly mortgage payment in terms of those interest costs and puts it into your pocket and fuels spending elsewhere traditionally.
And so how are rising interest rates now impacting homeowners that are willing to refinance their homes?
Well, it just makes fewer people willing to refinance because the incentives are only there if rates are low. As rates go up, and they've gone up remarkably fast, it leaves fewer and fewer people with a high mortgage rate that would benefit from refinancing. So we've seen about a 40% tumble in refinancing activity over the last year, which it should be said, this is what the Federal Reserve wants. You know, they want to sort of slow the flow of money through the U.S. economy, and this is one of the ways that they do it.
So that all makes sense, right? Interest rates are low. People try to refinance, so their monthly bill is lower. When they go up, it doesn't make any sense. Why you want to fill out all that paperwork? You don't need to do it. But so the question is then, what sort of impact could this have on the housing market and or the greater economy? Because you talked about what the Fed's trying to do is kind of slow down the flow of money. So that doesn't just impact the housing market, it impacts the economy.
Right. I mean, there's a lot of economic research that would spotlight the role of refinancing in other kinds of consumer spending. You know, people have it's not like everyone's putting all that money in the bank that they would have spent on their mortgage every month. So they're buying new cars, they're buying, new appliances for their house. So that has an economic effect. I should also point out, though, that the refinance loans are somewhat of a different animal than purchase loans. Purchase loans haven't fallen as fast, and that's sort of reflects, some of the changes in the economy since the pandemic. People are just really interested in being in houses and sort of trying to get out of apartments or shift to a little bit more space, add perhaps an office. So that part of the housing market has still kind of held up surprisingly well, even with higher rates.
Yeah, because the thing about it is, even though we've got higher rates, we also have a major shortage in inventory when it comes to houses. We've had a pandemic, 2 years of not building any houses. There's a lot of catching up to do, and we still have supply chain issues. So that is almost a whole other conversation that we could have, Matt, with you about that.
I'll come back and talk. I would love to do it.
All right, sounds good. Matt Phillips, thank you very much.
Take care.